All right, on to a major economic story at the heart of global trade. The U.S. recording a nearly $900 billion trade deficit last year. This coming despite sweeping tariffs on imports. We, of course, have been tracking the global supply chain so closely in recent months. Obviously, the numbers are raising questions about whether current trade policies are having their intended effect. Dan Varroney is here. He's an economic strategist and the CEO of Potomac Core. You know, if tariffs were having the intended effect, Dan, would the country have seen a trade surplus this past year?
Good to be with you again, Austin. So the answer is exports were up 6%, imports were up 5%. So we are seeing a minimal improvement. So when we look at strategy, everybody thinks that strategy happens in a day, a week, or a minute. And the answer is the strategy is happening in the following ways. The tariffs have been utilized as negotiating leverage. That leverage has gotten access for automotive vehicles and for parts in Latin America, in Southeast Asia, and Vietnam, and even in Japan. So that's one example of it. And over time, as we move forward through this year, next year, and the year after, we'll see continued export growth. In addition to that, there are companies, foreign-owned companies, that are increasing their manufacturing footprint here in the United States, whether it be automotive, whether it be technology, whether it be pharmaceutical, and they are going to be making product here and exporting it from the United States. My sense is, on the basis of the strategy by the Trump administration and what I'm seeing over this year, looking ahead to this year and next year, that I expect those export numbers to continue to improve.
Does it feel like we're a long way off from having a trade surplus?
So I think that from my perspective, when I look at some of the initial wins that I just talked about, and then the other part of it is that the imbalance with China is down 32%. So let's please chalk that up as a big win. Do I think we've got a long way to go? The journey of 1,000 miles, as they say, begins with the first step. We have taken some of the basic fundamental steps, and we're going in the right direction. And the other data point I want to share with you, Austin, and it's timely for this conversation on exports. Do you know that 97% of U.S. exports come from small businesses? And do you know what's holding small businesses back from exporting nowadays? It's the cost of capital. If the Federal Reserve would lower interest rates, that would give them the ability to be even more competitive and to export more product overseas.
So let's talk about $900 billion deficit. Some people might be looking, and I know a lot of people watch these segments and they hear these big numbers. Let's put this into context for people and make $900 billion make sense to them. In the scheme of things and in the scheme of past trade deficits and past reports you've seen, how big a number is a $900 billion trade deficit?
Make no mistake about it, it's a big number. Do I think it's as big as it could have been? Actually, it could have been a lot bigger. I think had the president and the administration not been as aggressive as they have been with negotiations, I think this number would have been far worse. So from my perspective, I see the export situation as a glass that's half full and not half empty. And I think for everyone watching tonight, let's look at the progress that we've made. The glass is half full. It is not half empty when it comes to exports.
Does it seem that imports are remaining strong despite the tariffs?
So when you look at over the past year, the increase in exports came in on the technology side, but there's a business rationale for that. There were substantial investments throughout the prior year in AI and technology, and a lot of those chips and products could only be purchased overseas. Now that we're sourcing more of those products here in the United States, I don't see that as a long-term problem.
When we talk about, and by the way, a live look at the White House, it's just past 8 o'clock there in the nation's capital. When we talk about an overall trade deficit, how should viewers understand the relationship between tariff revenue and the overall trade deficit?
So I think that while the president and Treasury Secretary Bessent are always energized talking about the amount of money that have been collected by tariffs, I am far more energized by exports, and here's why. Because the more dollars that are exported, right, the more products that are exported, the more dollars that are attached to that, the more American workers are at work. So that's the number that I focus on. I always look at the export numbers. Why I'm energized by all of these companies opening plants and building more equipment and hiring more workers here is I see more exports. Why I'm energized by the big, beautiful law and the 100% expensing for plants and equipment, I'm energized because that will lead to more workers and that will lead to more exports and lead to more revenue generation for companies and for the American people.
So, when economists say that a trade deficit is not necessarily a sign of economic weakness, what do they typically mean by that?
So, what they mean by that is that this is one in a series of data points. So, from my perspective, when we look at economic strength, to me, in my mind, the strength factors that I look at is the amount of Americans that are going back to work. The most recent jobs numbers, 170,000 private sector jobs created. Another point of strength is inflation is coming down. The consumer price index was down to 2.4%. Yet another sign of strength is there is more money in the American people's pockets. They're going to be averaging about $2,500 in tax refunds. So I think when I look at economic strength, we are in a much better place heading in the right direction.
Dan, always good to see you. Appreciate the time tonight.
Good to see you as well.